of an introduction, or?
Yeah, absolutely fine. Yeah, well, if I can just welcome everybody who's arrived so far and just explain what the intention of this was. This was actually an event that we had penciled into the diary earlier in the year. And a few people that have joined us today obviously knew about this going back. We had to cancel it because it coincided more or less exactly with the introduction of lockdown and social distancing. And actually, I think it was just after lockdown was announced. So we had to cancel it, unfortunately. And so I'm really pleased that everyone who's here today has decided to go with the technological approach. I think we've all had to get used to Zoom conferences, Teams, whatever. I mean, here at Acumen, I think we're using just about every system going. So it's a real case of, I feel a bit of a jack of all trades when it comes to these systems myself, because I'm having to use so many different ones. But thanks very much for joining us. What we're really keen to do in this event is to just introduce Praetura, just have a talk about some of the things that they're doing. I'm not going to steal any of Dave's thunder, but one of the things that we really like about this particular company is the focus on the Northwest, and obviously that's where we're all based, and it's our home and it's where our hearts are, I suppose. So that it's something a bit different from other companies that are operating in this space. We've got two back-to-back sessions. Next week we've got Foresight, and I think pretty much everybody who's here today is going to join us next week as well. And they're two very different approaches to a similar sort of issue, but looking at two ends of the continuum, if you like, in terms of the approach to investment risk and tax planning. So we're going to have a really good opportunity to look at how these investments can work, how they can form part of a financial plan, but also really just from the point of view of being an interesting hour spent with with people who are very specialised in their area, and is part of our value added objective with Acumen. So really, really pleased to welcome everybody. And we're going to hand over to Dave now. I don't know whether anybody else has managed to get to the waiting room. Have they, Dave?
Just added one more.
Yeah, I think, morning, Steve. I think one of my clients has just joined. Just before we pass over to Dave, one of the reasons why we're looking at this area and we've invited Dave, EISs, which is what Dave's going to discuss today, have some great tax advantages. And we're using them more and more for clients who may have issues where they've sort of hit limits with annual allowances on the pension or lifetime allowances on the pension. And it's a really good way of obtaining some valuable tax relief, whether that's from an income tax perspective or your clients who wanted to invest to avoid capital gains tax, perhaps, and even inheritance tax as well. That's another benefits of investing through these sort of structures. So I don't really want to dwell on the tax side of things because that's all well and good. And they are some advantages of investing in EIS, but the investment itself has also got to stand on its own, and that's where Dave and Praetura come in as well. We've spoken to a lot of EIS providers in this space, being really impressed with the process that they follow at Praetura and the opportunities that they're spotting as well. So without any further ado, I'll pass over to you, Dave, and look forward to the next hour or so.
Thank you. Thanks very much. So my name's Dave Foreman. I am a co-founder of Praetura. We co-founded the business in 2011. I've got some slides to run through, which I'll try and keep within 40 minutes. Very welcome to ask questions along the way or store them up and ask at the end. And as I say, I'll try and just whiz through the slides. So we've got a bit more time to discuss things at the end of that. And as John rightly says, there is tax advantages to investing in the way we invest. But fundamentally, we believe it's all about the underlying investments rather than the tax relief. The tax relief is an advantage, not a reason to invest. So I'm just going to try and share my screen. Hopefully this will work. If someone could let me know if the screen is being shared.
Yeah.
Okay. So Praetura, introduction September 2020. So today we'll go through where and who we are, the way we go about our investments in our business, give a quick update on sort of our portfolio, which gives really a sense of what we've been up to during COVID over the last 6 months, and then look at the end about the future of where we're hopefully going over the next year or 6 months. So who are we? So Praetura, we are the venture capital arm of Praetura Group. Praetura Group is a business that I set up with 2 co-founders in 2011. Since then, we've grown to about 100 staff. We have about 250 million of AUM, and we offer, alongside venture capital, we offer asset finance, which is lending against plant machinery and kit, where we have currently about 110 million pound book. We do commercial finance, which is primarily invoice discounting, which we set up in 2016 and has grown to a 60 million pound book. We've been going along the way since 2011. The reason we set up, it's quite good timing at the moment. So one of the reasons we set it up was we were working previously at an investment bank, Altium in Manchester. We were very lucky to work with some of the Northwest's, best and finest entrepreneurs. I advised the Hut Group when they raised their first round of funding back in 2009, 2010. And while it's obviously sort of, a massive success story today, I think floating next week for 4.5 billion, back at the time when they were raising their first £6 million of sort of institutional money, it was very, very difficult to raise that capital. There just weren't the firms in Manchester looking to invest in that type of business. A similar story happened with AO.com. So I advised AO.com in 2009, again, looking for investment. They were unable to raise funds from the Northwest financial scene. So they raised money from, I guess, private high net worths. That was in 2009. In 2014, they floated for 1.4 billion. So we sort of saw those examples and realised there was something wrong with the North's sort of financial services investment scene. There's a thriving private equity community, but in venture, investing in early stage businesses that are looking to invest in their team and their technology to grow, there just wasn't the capital available, and you had to go for those sort of processes, you had to go to London, into Europe, or over into America to try and find this capital, which obviously isn't easy. So we decided to set up and try and do something about it. In 2018, we formed the Praetura Group, which put the 3 trading businesses that we had co-founded together. We raised significant capital from investors for our business, as well as raising capital from investors for our funds. The capital we raised has allowed us to grow the team significantly over the last 2 years. And take 2019 or tax year 2020, Praetura Ventures raised £23 million across 2 funds of EIS. We looked at over 1.5 billion of opportunities to invest in the companies, and we made 12 investments over 11 months, which is it's a great indictment of how we've progressed as a business over the last few years, and we've grown the team in ventures to about 20 people now. The reason we're able to sort of invest in so many businesses and invest so rapidly, which is one of the things that's important for an EIS investor, knowing when the tax advantage is likely to hit, is because we have far more opportunities than we have funds available. That allowed us in 2019 to fully deploy our first fund in 8 months, and we are close to fully deploying our 2020 fund, which we closed in January 2020. Would likely have deployed that fully by the end of the tax year, so March 2020, but obviously COVID hit, and we then put a pause on funding, A, so we could support our portfolio, and B, because we didn't feel like we had any certainty of any projections with the companies we were looking to back at the time. So we put a pause on that. We're now redeploying capital, and we're about to close 1 deal tomorrow, I think, and a further deal by the end of the month, which will then be the 2020 fund fully deployed. If we look at sort of what we've deployed it into, we invest into a wide variety of business sectors, and we go across a range of sizes in the venture capital sphere, and we think that diversification is really important. So we're always looking at sort of raising a fund and investing into 6 to 8 high quality early stage businesses, giving investors that diversification across a number of businesses rather than being, saturated into 1 or 2 deals. We look across a range of sectors, and we look also at what the end customer is. So we don't have any particular concentration in any one particular sector. I'll come on to sort of our investment criteria later, but it is important to us to have that level of diversification in sectors. In the size, which is the bottom chart, we invest across sort of what we call seed, development and growth. So seed would be sort of very early stage, sort of 0 to 5 million pre-money valuation, circa just less than £1 million of revenue, and sort of probably got 5 to 10 team members. In development is sort of 5 to 20 million of pre-money valuation. You're looking at $1 million plus of revenue, real sort of traction, and where we look for there is sort of real momentum in the business. And then growth, we've had 2 businesses in the growth sector, which is north of sort of 20 million valuation. Those are businesses that would be approaching 3 to 5 million of revenue as we invest. And again, it's really important to us that we have that diversification in the stage of businesses we invest in, because obviously the ones that are at the growth level are much closer to an exit than would be the case of the ones at the seed stage. So EIS, you have to hold the business for 3 years to get the full benefit of the tax reliefs. So we're always looking at a 3+ year horizon. But where we're looking with the growth businesses, we're looking to sort of exit those within years, 4, maybe 5. With the seed ones, we expect those to last a bit longer and maybe a 7-year hold. It's very important to us though that we can see how investors can get money back from sort of the end of the EIS period right the way through to say 7 years of a hold. So it is a long-term investment if you do make these. The one area we're much less diversified is in region. I think it was mentioned in the beginning. We are huge supporters of the North. We believe, A, that's where we're from. B, there's much less competition here, so you don't enter the sort of London venture capital echo chamber, all looking at the same deals and driving each other's valuations up. And C, we think that there's a huge opportunity to effectively gain some sort of arbitrage in valuation, because generally businesses that are looking to raise money in the north of England have much more realistic valuation expectations than those in London. So our thesis is if we can sort of buy locally and sell nationally and internationally, which is something we're sort of doing with some of our later stage businesses, we think the real opportunity for investors to get sort of outsized returns, and that's something we've been able to demonstrate in the past, and hopefully we'll be able to continue to demonstrate going forward. Sort of, I guess that's kind of where we are in terms of what we do and how we go about it. We are always looking to businesses. We're looking to back management teams. We don't look to back sort of individual founders who are the sales director, the tech director. They do the books at the weekend, because we genuinely believe that a single founder is just not able to scale the business at the pace we're looking for them to be able to do. Equally, a single sort of one individual founder with no team around them very often can't deal with the inevitable bumps in the road. And that's been really proven during the COVID crisis. The big thing we look for in a business is recurring and generally B2B revenue. So we aren't really looking for sort of e-commerce or direct-to-consumer investments. We're looking for businesses that are providing services generally in a recurring revenue way to other businesses. And we believe that's because we can actually understand what a business is looking to buy, rather than sort of the fickleness of consumer. And again, sort of if you look at COVID, that recurring revenue nature of the business we backed, plus the fact that they were generally serving businesses, has stood our portfolio in good stead. We didn't have any businesses that were selling to consumers that effectively had zero revenue overnight when COVID and the lockdown happened. And I guess the third sort of tenet of what we're really trying to do with businesses we back is to fund them properly. So we would always be looking for 18 months plus of runway on a sensitized case for an investment. The sort of the worst thing we believe you can do as a venture capital investor is to invest a too small amount of money, which then drives wrong decision making by the founders, It also creates problems down the line when eventually they come to a point where you're running out of money. They haven't had the time and the runway to be able to sort of achieve or demonstrate, greater momentum and traction, and that creates a funding problem. If we're not prepared to invest a significant amount of money, we don't invest at all, and we would rather invest more money to allow them to build the team and scale the team properly than to try and nickel and dime it on the way in. And that's something, again, when you look at how we've performed during COVID, and our businesses have performed during COVID, they all had enough sort of wool on their back, to use a simple phrase, to be able to withstand the effect of COVID, to sort of hunker down, make some changes in the business, and to also come out the other side and see the opportunities that will inevitably happen post sort of the end of lockdown and the easing back into sort of more normal society and the economy. The other thing we do on sort of once we've invested, which is the bottom 3 points, we continue to do sort of diligence post investment. So it's very sort of, I guess it's an easy trait to fall into for founders who raise money for the first time, to suddenly think they've got $1 million plus in their bank account to go wild with hiring and plans for the future. We make sure that they don't do that. And whilst we are, we're supportive of aggressive hiring plans and going for growth quickly, if the growth doesn't come through and the revenue doesn't start coming through and the pipeline doesn't start building, we make sure we're there with them to sort of guide them against continuing the hiring plan regardless, because that is a surefire way of running out of money and ending up as one of the companies that fails amongst the portfolio. We also use our team's expertise, so we have a dedicated portfolio team. The people in the portfolio team are people who've been there and done it as entrepreneurs, so they've founded, scaled and sold their own businesses, or they've led early stage businesses through sort of several growth stages, so they can act as real sort of guidance to the founders as they're sort of on their own journey. And we make sure that we've got those skills within the team to provide them to the portfolio. And then the third thing we really focus on is sort of having real-time data. So when we started, we looked around the market, and we found there was no system to allow us to get the data we wanted on the businesses we were looking to back. Most people in private equity and venture capital still rely on board packs and management accounts being sent via email. We built our own reporting system and portfolio monitoring platform, which goes to source financial data from their accounting packages, which then allows us to analyze the business in much more greater detail, and also that allows us to really identify risk in a quick and efficient manner. So by day 15 of every month, we have every single portfolio company, core KPIs, core financials, analysed it against their forecast, and again analysed it against their cash forecasts. And with that, on every month, we can then grade our portfolio in terms of risk and apply our resources where it's most effective. And that's kind of the way we go about it. In terms of what we look to back, we've got kind of effectively 5 things we look for when we are looking to back a business. The sort of early stage bit when we're first meeting a company is all about the model and the market. The model is all about recurring revenue, high margin product, and minimal working capital cycle, as we believe those are business model traits that allow a business to scale quickly. In our sort of past, prior to sort of forming Praetura Ventures and raising these funds, we'd had some great success. We'd also had some things that didn't go as well, and they were generally around where the business model and the market just didn't allow the business to scale, despite how well the management team may have well performed. And so we're always looking for sort of that scalability in the business and a big enough sort of part of a niche market that there is an attractive opportunity for the business. Once we've kind of got through those 2 phases, we're really looking at sort of the management team and the momentum in the business. And this is where we spend sort of time looking at, and paying external consultants to help us make these decisions. So the management team, we're looking to meet them and check, see how full the management team is, what the level of support underneath the founders is, how high quality the people are, and also, being candid, how sort of culturally aligned they are to us. We spend so much time with these management teams, either pre or post investment, that if they're not aligned to us sort of culturally, or we don't enjoy spending time with them, we're better off not investing, because inevitably you will end up spending time with them post. Things will go wrong, and you've got to really want to back the team to sort of go through those struggles with them. Momentum is where we spend like most of the time doing diligence. So that's where we're looking for, you know, contracts being signed, the pipeline being sort of, you know, people going from pipeline into actually converting sales. And we usually do customer referencing on clients. We also do pipeline referencing. So we would speak to people or businesses that are on the pipeline list of clients and actually see how close they are to signing or actually buying the product. This is where the vast majority of businesses fail our tests. We also probably spend sort of 5 to 6 months in the process of looking to invest. So we check sort of what the pipeline is on day one versus where the pipeline is after months 4 and 5. And if you haven't seen progression through that pipeline, we're just not in a position to invest. We're always looking for stuff that they've got real momentum and they're winning clients. So free trials don't count. You know, pilots that are just sort of, you know, a free pilot don't count. We're looking for paid contracts where people are paying for the service and paying the amount that people get them to pay post our investment. And the final big sort of checkpoint for us is, can we add more than money? So that's can we add value to the portfolio? You know, we don't believe that we should invest if we don't think we can help them in any way. So that could be either sort of helping them scale the business, helping them sort of create a sticky SaaS revenue stream, helping them with introductions to clients, having problems that they, you know, we think that they may encounter. Unless we can do something like that, then we shouldn't invest. You know, there are other people who are much more hands-off than us. We're not executive, but equally we're very much active as an investor, and we want to be involved. And if the founders don't want someone who just, if they want someone who just sits on the sidelines and sees how they get on, that's not for us. So, you know, we are unashamedly active in what we invest in. And all of that sort of means that from the circa 100 deals we get in a month, probably 2 make it through those sort of those filters and end up being things that we look at in any great detail. On top of those investment considerations, we look at diversification, as I mentioned before. So we're looking at sort of the size, the region, the customer base, the sector, and we're also sort of, you know, we're very keen to try and do some social good. So where a business has a social good or an ESG agenda, or is tech for good, or sort of drives diversity, that is something we see as a positive throughout our investment process. We didn't sort of drive this, but out of our current portfolio of 12, 4 had female founders, 3 have female CEOs, and 2 are all female founding teams. And that's something we're extremely proud of, as being, because when you consider that the average is about 1% of venture capital funding goes to female founders, you know, for whatever reason, we seem to have been able to back really exciting businesses founded by female founders without sort of going out of our way to find them. I think one of the reasons we do that is because we will happily look at any deal that comes into us, whereas a lot of VCs tend to want people to introduce them, which I think just completely drives diversity out of venture capital, and that's something we're sort of striving against. Post investment, we do sort of 2 things. So we look at adding more than money to our portfolio, so adding value, and then openly and transparently communicating with our investors. You know, I think probably for those guys who are from Acumen, then they will have seen previous sort of, or other EIS investors whose communication could leave a little bit to be desired. Our view is to be completely open and transparent, to the extent where certain of our investors, if they are what we call a venture partner, actually have full access to all of our investment committee papers. So we are completely and utterly transparent with our investors, and all investors get, when we invest, they would get a sort of 20-page document which details we're looking at why we've made the investment, why it's fit our criteria, what the financial forecasts are, where the areas of risks we see are, and also sort of I guess, why we're happy with valuation and making the investment. And we're very happy to sort of have debates and communications expertise, our toolkit and our network and partners to assess, to help businesses in any way we can as they're looking to scale. The portfolio toolkit is something we've developed where we are looking to sort of use the group scale and the portfolio scale to get beneficial sort of partnerships. And through that, on the tech partnership we have with AWS and Microsoft Azure, we were actually able during COVID to save our portfolio businesses £700,000 worth of cash in credits against tech spend, where they would usually be spending money on Microsoft Azure, AWS, or things like HubSpot, which is a CRM system. And we're looking to constantly roll out that toolkit. We also have partnerships with PwC on tax R&D tax claims, which is something that people generally underclaim on. And we were able during COVID to get an additional £300,000 of funding back into businesses by reopening tax claims. And we also have partnerships with people who help our portfolio go for grants and other sources of funding throughout that are available to them. So effectively what we're trying to do by putting our people, our system, our real-time data analysis and our network to play on the portfolio is to help them drive revenue, reduce cost, reduce risk, increase their efficiency, and I guess fundamentally trying to help them avoid the missteps that we've seen across the last sort of since 2011, so 9 years of Praetura, in which we've backed now 32 early stage businesses. And as I said, we've achieved some great successes there, and we've also learned from our mistakes along the way. In terms of sort of open and transparent communication, we do regular detailed reports in April and October to our investors. These are highly detailed reports. I think the last one was about 85, 90 pages, where we're providing detail on every single portfolio and on our business, and showing the numbers and showing their progression against the plan that we originally said when we're looking at, which I think gives investors a real sense of confidence that we're being open and transparent with people, but also gives them a real insight to the business. And we believe that if we sort of share all that data and the business is sort of needs, we're hopeful, and this has happened along the way, where an investor might read the report, have an idea, think of someone who might be able to help the business. We've really seen that network effect taking off as we've grown our investor base and our sort of network there. When we've done the reports, we also do video calls every 6 months with investors. We also put on individual video calls during the middle of COVID, where we talk through the portfolio and where we're up to. And we encourage all investors to join those video calls and ask questions as they see fit. And then we have a portal for our EIS and report. So we have an online portal that all investors get access to. Advisors and tax advisors can also get access to people's portal. We put all our EIS3 certificates on there and all documentation regarding investments, because one thing that is a historic thing and an ongoing thing with EIS investing is HMRC seem to have designed the process to make it as difficult as possible to get for people to get tax relief. It's a highly manual process. It's at the whim of HMRC. We take all of that problem away, deal with it ourselves, and put the EIS3s onto the portal for you as investors. And we've been able to sort of get our EIS3s back to investors within about 6 weeks of investment, which is something that we sort of monitor all the time with our investments. The reason we're able to do that is because we get pre-approval from HMRC before we make any investments on behalf of investors. So i.e. it will qualify for EIS. And the second thing we do is on the day we complete, we send in our forms to HMRC. it isn't something we wait and batch up right now. We do it individually, and we do it on the day we invest. It's something that's part of our sort of pre-completion and post-completion checklists. So in terms of sort of what we've done, and you know, I think the portfolio, these names won't mean much to you, but I think it's about what I want to show is just kind of how we go about things, and also what happened in COVID. So COVID obviously has affected everybody. It's affected every business. We're all on Zoom now because of COVID. The way we sort of reacted during that was to increase our commitment to providing more than money. So as I said right at the beginning, we paused our investment process. We didn't make any investments between March and now. And well, in August, we made our entire investment team available to the portfolio, which meant that we had 13 investment professionals looking after a portfolio of 12 businesses. We also drafted in our group HR director, who was made available to our portfolio, and they were able to help with individual bits around what the portfolio needed. HR was a particular thing because obviously most people ended up furloughing staff. Most people did a salary sacrifice scheme. Most people then sort of made up with that with an EMI scheme, and also, you know, you have made redundancies along the way. Most of the businesses we back aren't of a scale where they have a HR director. We made ours available, and she's been hugely valuable to the portfolio throughout the entire bit of COVID. We were also drafting CBILS application. We were helping them with grant applications. We were helping them with sort of the things on the portfolio toolkit I talked about before. So we got really involved and made sure that our portfolio were able to sort of come through COVID. And sort of when you look at,
could you give me 5 minutes?
When we look through sort of the graph, so VC is all about sort of cash management. This is the graph of sort of the sort of lighter bars are the cash runway pre-COVID, and the white bars are the cash runway post the actions we took. And across the portfolio of 12, we were able to add, through our sort of work and the amount of money we were able to get back into businesses, 46 months of additional cash runway before they were looking at further fundraisers. And what we did was, because we could get this data straight away, so by the end of March, beginning of April, which was when lockdown happened, we already had a great view of who were most at risk, where their cash runway was. We were able to focus in on the businesses that needed the most help, particularly around cash, and we were able to sort of proactively go and look at new fundraising, working with partners, and also bringing cash into the business and helping them with their cash management. So we were working with them on 13-week cash flow. And I'm pleased to say now that every single business we have in our portfolio has significant funding, and they're all into 2021. And where there was a cash requirement, Steamaco have completed their fundraise. Peak will complete their fundraise this week or next week. Innertech will complete their fundraise this week or next week, and Doctor Fertility are in sort of active discussions and sort of progression with their fundraise. Within that, our investors have invested a little bit into Steamaco, but the rest is all done via partnership and us going out and finding other investors for the business, which allows us to maximize the runway for these businesses. So we feel like our portfolio has done really well out of sort of what is a trying time in COVID. In terms of sort of what we do from an ongoing portfolio projects, we're looking currently at sort of commercial finance and designing, implementing, and sort of putting in KPIs with one of the businesses called Patchwork. We've done a full rebranding and messaging culture shift. We are looking to attack the corporate market, having been mainly focused on universities. We're working with sort of 2 businesses now around their sales team development. So what's the right structure for a sales team, implementing CRM systems, helping them hire SDRs and also generate leads. And we're also, as I talked about before, also working on employee engagement pretty much across the portfolio. We've got a few good news stories to sort of share with people. So Patchwork is a deal we did in January 2020. It is a NHS staffing tech solution. They have sort of grown from sort of £600,000 of annual recurring revenue to 1.5 million now, and expect to be at 2 million by the end of the year. And their revenue has tripled in the 6 months since we invested. They've also, one of the key things for us when we invested was to expand their products, and that's happened through the course of COVID as well. And that business is really set up for sort of, you know, significant and fast growth, and we're very excited by where that business is going. Peak AI is a business we've backed in sort of for a long time, so in the pre-Praetura Ventures days. And this graph here, the sort of the blue line going from bottom left to top right, which is a graph we all want to see when we're looking at venture capital, is kind of their recurring revenue. And since sort of May 19 to June 20, they've grown that from 2.1 to 5.3 million. They're now adding about $1 million of recurring revenue every 60 days. And the business is just in the process of completing a £12 million fundraise with a major European VC at 54 million pre-money, which is an increase on the investments we made with our funds in 2019. They've just done superbly throughout COVID, and they've managed to continue winning global names such as Nike, AO.com, Foot Asylum, JD Sports. They've won a huge amount of new clients, and they're just going from strength to strength. We're very excited about that. Sorted is a delivery management platform, which we've backed for a long time as well. They have sort of, since we invested, they've gone from sort of a 2 million pre-money valuation to being backed at 50 million pre-money by Merrion Chrysalis, who were a backer of the Hut Group, Boohoo, and AO. So they've really got some backing from some very credible venture capital firms alongside us, and that's going superbly well. They've never sort of been in a better position. Obviously, they do a lot of the sort of the tech underlying delivery for the likes of ASOS, for the likes of Boohoo, and they effectively earn money on every purchase made online by those clients. And obviously, e-commerce has gone through the roof over the course of COVID, so that's in great shape. On sort of I guess that's 3 great stories out of 12. There are some that have performed less well. One of those is Steamico, which is a business we first backed. It was one of the first businesses we backed out of the 2019 fund. Throughout the course of 2019, pre-COVID, they generally underperformed against their plan. They had a significant pipeline, but they struggled to really convert some of the sales post our investments. COVID has hit them pretty hard, so they provide tech into global infrastructure projects that help people without energy get onto the grid in sort of the emerging world. So those infrastructure projects have really struggled during people's funding for those have struggled during COVID. However, we still believe very, very strongly in the management team and the sort of business's prospects. So at the beginning of COVID, when it became apparent that there was a need to fundraise, we effectively went out with our partners. We've secured 3 million of funding, which includes the Future Fund. It includes Innovate UK with a funding of £1 million, and it includes our partners Shell. We led effectively it was a down round against previous valuation, which we led as being part of the decision making on that valuation. I think is something that most VCs find to be a negative thing and they don't want to participate in. We led that down round, but we were able to, by leading that and sort of and driving the process, we utilised £300,000 of our 2020 fund out of the 3 million. But we also secured effectively bonus shares for our 2019 investors to minimise the effect of the dilution that came from the down round and the funding. So by sort of being ahead of the game slightly and understanding where this business was, we were able to get a great deal for us and our investors, whilst also sort of providing significant runway for the business, who now has sort of cash runway into 2022, and therefore has the opportunity to sort of go back to where they started and really start to build up again post-COVID. Looking forward, sort of COVID has had an impact on everyone, as I said before. our opportunity has increased. There is a significant funding gap in the north. But funding competition is reduced because people are raising less money, and also I think people have seen that the more the money approach we are absolutely wedded to is really valuable in times when times are tough, and we're also very supportive backers of businesses. So we think that our opportunity is increasing. That's sort of borne out by, I guess, the number of opportunities we're seeing, which grew 50% in the sort of, I guess, in the immediate period post lockdown. August again will be up at 100 by the end. So August and September will be up at 100 by the end of the month. This is slightly out of date, so apologies for that. And we're sort of looking at 20 deals actively progressing. We have 24 million of investments sort of actively progressing through our investment committee process, which goes from, we have an initial sightings, which is kind of a team look at the business with the investment committee around sort of, does it fit? Do we like it? Are we interested? We then go away and do a hell of a lot of work, which takes months to get to IC1, so the first investment committee, where we're sort of really looking at businesses and whether they fit. And that's when we also then commission post IC1 external paid diligence before we get to sort of the final investment committee. We have 9 businesses through that initial sightings, which equates to 24 million, and we're looking to raise a fund of about £7.5 million in September. So we have significant coverage for that fund in terms of deal opportunities, which we're very excited by. In terms of those deals, we've got a deal that's closing tomorrow in cybersecurity in Leeds. We're looking at a very innovative water tech business in Manchester, which provides sort of digitisation of water pipes throughout sort of, I guess, the water wastewater infrastructure in the UK, which has partnerships with UU, Severn Trent and Anglian Water. We're looking at a business that's based in Audley Edge that has the people there responsible for most of the sort of transition of drugs from prescription only to over the counter. So things like Nurofen, which you'll have heard of, and they have the rights to bring a progesterone only pill over the to sort of from prescription to over the counter to sell it in Boots. They have partnerships with Boots and Superdrug already in the pipeline. And that's something we're really excited by, as well as other sort of over-the-counter transitions in the pipeline. And then there's a SaaS business based in health. This is a London-based business, but is performing significant. Is absolutely flying during COVID, adding about 5 to 7% of ARR every single month, and that's an opportunity we're looking at again for the 2020 fund. And that kind of brings everything together as being what we're looking to do, which is the Evergreen Fund that you guys might be interested in looking at. This is a fund that carries the sort of evergreen, means it kind of carries on ongoing. We do a soft close every 6 months, so September and March, and each soft close would then be intended to invest in the next. Each soft close would then intend to be fully deployed in the next 6 months, which gives you certainty on the tax reliefs that you're looking at from an investment. We are closing our first fund in September at the end of this month, and then that investment will be deployed in tax year 2021, which means from a tax perspective you can claim the relief in tax year 2021 or carry it back to tax year 20. The next close after that will be in March, where we would deploy it in tax year 2022, making the reliefs available in tax year 22 and carry that to 21. And that is hopefully whistle stop tour. I know I thought a bit longer than probably was planned, but that's the whistle stop tour of Praetura Ventures. And I'll stop sharing my screen.
I'll just take myself off mute again for a minute. So, well, I hope that actually gave everybody a really interesting insight into what Praetura are doing and how they go about it. Has anybody got any questions that they'd like to put to Dave?
Yeah, a quick one, if you can hear me, it's Steve.
Yeah.
Yeah, so no, really interesting. Thanks for that. I think you sort of covered it at the end with the fund effectively ending any additions to it in September, and then to be deployed over the next 6 months. I suppose, do you ever envisage where you sort of end up investing in something suboptimal to make sure it does get the tax benefit?
No. We are a venture capital business first and foremost. It is all about the quality and investments. We will not make investments for the benefit of the tax timing. We demonstrated that, I guess, with the 2020 fund, which was intended to be deployed fully by the end of the tax year. We went back to our investors in that fund, and immediately that COVID everyone realised what COVID was, and we said we're not going to deploy it. Ultimately, the way people will judge us is on our track record, and doing deals for the sake of the tax benefit of being in a certain year is not the way to optimize that ultimate return. Where we're confident that we are able to deploy effectively so quickly post the fund closing is because we've effectively already know the deals that we're looking at for our evergreen one. They're already in our investment process, having gone through various stages of our investment committee process. And we already have the 7 or 8 names that we are likely to invest in the September fund. We already have a backup list of things that are coming down after those, things that are slightly later in the process. There is another 10 businesses that are early stage identified, because we're working on a 6-month process for investing. We already know the businesses, so we're confident we are able to deploy, but always with the caveat that we will never deploy something just for the benefit of the tax, because that's just not the way we're set up.
No, that makes sense. Yeah. And then, so do the investors then get the option of getting the money back, or does it get invested but without the tax benefits?
Well, it gets invested. So the fund would carry on, and we would invest if it went over the intended timeline, intended year. We would continue to invest. The tax would then effectively be available in the next year. So it's not that you lose them, but I understand that it may not be optimal for your planning. So we always say, when we're talking to investors, we're fully confident of deploying the capital in the year we intend to. And that particularly would be the case, if we close in, say, March, April time, we'd definitely invest 100% within the following tax year for that tax year and clawing back. In the September one, we always advise that we fully intend to deploy the capital within the tax year, but we aren't able to guarantee that, and therefore that needs to be taken into account when tax planning. We'd anticipate something like 90% being deployed, by ordinary course, but we always make that clear. We can't guarantee it, because that's when you do find yourself with conflicts of interest.
It might just be. Sorry. Sorry. Did somebody have a question?
No, it was just a thanks for that bit. Yep.
Oh, okay. Sorry about that. Yeah. I just thought it might be just worth refreshing. If anybody's thinking what the tax benefits are of this. I think it's. I think I'm right in saying that the minimum investment in this is 25,000. Is that's correct? And the maximum for an EIS is 2 million. So there's a reasonably wide range there, if anybody's interested. But there's potential 30% tax relief. But one of the key issues about the timing of the investment is that you can carry back into a previous tax year. So picking up on what Dave was just saying about hopefully, the intention being to deploy 90% of the investment within the tax year, that could be very useful for somebody who's perhaps got a tax liability from a previous tax year. Obviously, that's something that might be worth considering. So you've got that 1 year carry back, and it's capital gains tax free after 3 years. and out of the estate. So if you're looking at anything for inheritance tax planning, it's out of the estate within 2 years. So that's something that, you know, from a tax planning point of view, there's quite a lot of aspects of this sort of investment, as well as the benefits of a very well researched and very actively managed fund as well.
David,
Yes.
if I could just ask a question. Do you classify your company as a venture capitalist? Do you put yourself in that bracket?
Yes, 100%. We're a venture capital business who happens to raise money from EIS. Our plans will go to being an EIS fund as well as institutional funding. So we just happen to be raising money from EIS. We're not. I think there's a danger with EIS where people become an EIS provider, almost like a tax product rather than a venture capital. We are unashamedly venture capitalist by nature. That's our business. We just happen to benefit from some of the tax. We happen to utilize some of the tax benefits to help us raise capital from this market.
Okay, so for us as potential investors, we would presumably need to not only talk to your good selves, but also talk to Angela about any tax angles that we need to consider, i.e. it's a long time since I've thought about EIS, so, you know, refreshing in how all that hangs together, etc. How does all that work?
Yeah. So I guess between ourselves, so we have Steve Green who's on this call, Angela, who I assume is your advisor, and ourselves. We can go through the various tax planning angles of this. We've got a raft of sort of further documentation, sort of detailing our history and where we've come from and what we believe in. So we've got an IM. So you go through that process, and then there's effectively application form, client take on. We have to do the whole anti-money laundering stuff, application form, and then send the capital. And then effectively we make investments on your behalf. We issue you with, you know, details of those investments, and then the EIS3s. Those EIS3s can get bundled up and sent off to HMRC, either, you know, by yourself or on your behalf by Angela or your tax advisor, depending on your particular situation.
Okay. Yep, thank you.
Was that a good summary, Steve?
Sorry. Yeah, I think probably worth saying that, yeah, fundamentally the first line of the financial plan would come from Acumen. We would certainly support you in the same way that we have today, from the perspective of, you know, giving you insight into Praetura as a fund manager and a venture capital business. But the first line of any tax planning, wealth management would come from the Acumen team, and we would kind of support them with our insight, if that helps, Phil.
Okay, no, that's great. Thank you. Yep.
Gary,
I think you had a question.
Maybe just maybe a naive question, Dave. I'm not sure, but I mean, a very thorough presentation. I mean, you know, hopefully we'll get a copy of the presentation so we can. I made notes during the 40 minutes. Yeah. What level of return are you expecting? And I guess following on from what Phil said, as investors, what level of return would we be expecting from this?
So it's a bit of it's a very good question. I'd probably give a different answer. So I'm expecting to make 3 times return for investors. Our IM, because it's been drafted by people like Steve and John who work with the IFAs, says 2 times. So that's on a gross basis. To give you a bit of a sense of that, we were on the deals we did from 2011 on the equity investments we made between 2011 and 2014. And I probably should have mentioned this during the presentation, but there was plenty to go through anyway. We have returned already 4 times money on the investments we made between 2011 and 14, and we fully expect to return north of 6 times because we still have some investments left. Within that sort of portfolio, we had a business called Inspired Energy PLC, which was our first deal that we funded. We bought, funded, then floated, and I guess that kind of is our heritage. So I went on the board of that business. I became the FD. We did the float. The business went from sort of less than $1 million EBITDA to 20 million EBITDA, and that returned 16 times to investors. And that's obviously been a big contributor to the cohort of businesses that we invested between 2011 and 2014 returning about 6 times to investors. From 2014 to 2016, we had a further cohort of investments, and that has returned already about 2.5 times, and we expect to return north of 4 times money gross to investors. Again, within there, we had one outsized return. So we invested £600,000 in a business called EC3, which is an insurance brokerage business. And we returned £12 million to investors on that £600,000, so a 20x return. We also sort of backed an early business called PIB Insurance, where we returned 4 times money to our investors, having sold it to Carlisle Private Equity within 18 months. So those are the good things. In each of those cohorts, there are businesses that haven't gone and have returned nil to investors. And it's important to note when a business does return nil to investor, you do get actually additional sort of tax benefits for that loss on any one individual deal. So I guess that's a long-winded way of saying I'm aiming as a venture capital business to return 3 times money to investors. For reasons of documentation and not scaring IFAs and planners, Steve and his colleagues John and Sandra and Mike have convinced me to write 2 times in the IM, but I'm absolutely aiming for 3 times money. To achieve that, we need probably one really good deal out of any portfolio of 6 to 8 businesses, and that's the maths you get. If you get one really good one, you can return significant returns. And I think, to be fair, in our portfolio, we probably have 3 or 4 that we think could be fantastic. And then obviously with the other ones, you're looking to get your money back. One thing that we do on investors' behalf, we generally have a prior return. So if there is any money going out available to investors post sort of a sale or an exit event for any of the businesses we back, generally our investors get their money back first, and then we share the sort of proceeds, the equity proceeds thereafter. So by doing that, we actually have a way of sort of mitigating the risk for our investors, but also enhancing the returns for investors through our structuring of deals that we invest in. So I'm aiming for 3 times. It's probably the simplest answer I can give.
Okay, maybe just a follow-up question, Dave. I mean, in terms of the fund that's being, I guess, launched at the moment now, are we up against the time penalty now? Is it closing the end of September? So we have to make a decision in the next 3 weeks, or? Yeah,
so the fund will close at the end of September. The process is pretty quick if you do decide to invest. The important point on that is there is a process to go through, and you do need to have cash into our nominee by the end of the month. So that is quite time sort of sensitive. I guess one thing for you guys to think about is, obviously we planned to have this meeting way back when, prior to sort of COVID and lockdown, which would have given plenty of time to have these conversations. But if you're not, it's not that this is a one-time only thing, and the relationship with Acumen isn't a one-time only thing. We're raising every 6 months. So whilst we would obviously love you to invest in the September, if that's not possible, that's not to say this opportunity, there is no further opportunity. So we're raising every 6 months. Steve, do you want to add anything to that? I'm guessing you get that question more than.
Yeah, I mean, very specifically, as Dave said, that the fund will close on the 30th of September. I guess the real time sensitivity for being in this fund would be someone that has got more critical tax affairs in 1920 than they're likely to have in 2021. Because as soon as we close that fund and we deploy over that, what will be a 6-month period, the next fund would then be closing in March, which wouldn't be then deployed until the tax year 21-22. So your span of tax years there would be 2021, 21-22, rather than 19-20 and 2021. Hopefully I've got that right.
Yeah. I think you have. I think there's lots of dates in there, but I think there's a lot of dates
in there. But yeah, critically, if you've got a affairs in 1920 would be the real important thing, Gary.
What I would say just about that is that for our individual clients, if there are any specific questions about that, just please get in touch with your own normal dedicated advisor. We'll all be here able to answer any specific questions for you after the presentation. And if there are any other queries that you want to ask that you don't want to ask in this forum, then obviously that's the time to do it.
I think looking at the date, it's the 9th. There's, 21 days is more than enough to get an investment made and go through the process. It probably takes, from getting an application, Steve, I guess it takes 3 or 4 days just to do, at the absolute minimum, to do the AML and all that sort of stuff. Is that right?
24, 48 hours, we're getting the AML through now, Dave.
So you've got a bit of time, but it is a, there is a close at the end of this month.
Has anybody else got any questions that they'd like to raise?
I suppose really what goes through my mind is listening to David's presentation, which was fantastic. Thank you very much for that. It was really good. Is really, as an investor, working with your company, I think you're driving at investment growth rather than tax savings.
100%. Yeah. We are 100% driving at growth. The tax saving for us is something that investors benefit from, and maybe that's part of their decision. But this is a growth investment looking to return a multiple of the amount they invest. And therefore it has the associated risk on that. We mitigate that risk as much as we can through our process and our structuring. But this is a growth product.
But one thing about that, as I said at the beginning, we've got these 2 back-to-back presentations, with a few days in between, but we very specifically chose the 2 companies, Praetura and Foresight, to offer 2 very different views. They're looking at the same EIS structure, but looking at it from a completely different angle. And I think everybody who's here today is also coming on board next week. So, I think you'll see a very different angle on the same type of tax planning. So I think that was, for us, was one of the real benefits of having the juxtaposition of these 2 companies. So has anybody got anything else they'd like to say or ask of any others?
Angela, is it possible, the presentation was very good, David, so is it possible to get the presentation or a brochure? Just, I know what I'm like, I'll walk away from here, I need to still read something.
I'll just interrupt on that one, Gary. Yeah, we've actually recorded the session, so we'll send a copy, a recording, because I know there's a few other clients who couldn't make it today who wanted to be involved. So yeah, we did record it. So I'll send you a recording, and Dave, I think you've got brochures that.
I think we can. If I send the team, if I send you, John, an email just with, probably put our IM on there. I'll put a couple of examples of deals that of the communication we put out for when we've done deals, and then I'll put a copy of this presentation on it. I think we can. That'll probably do the.
Yeah, no, that's that. Yeah, is that all right, Gary? If we get some documentation and a recording across, we'll do that to all attendees. But I think, Phil, you really hit the nail on the head there. That the importance for us as your advisors is, it was the investment that drove the connection with Praetura. There are other EIS schemes in there that give you all those tax benefits, but really struck us about Praetura is that not only were you getting those tax benefits, but a really well researched and a really good investment process that sits behind it. So yeah, first and foremost, the investment is the important thing, the tax breaks. And that will differ from individual to individual, because everyone's situation is slightly different and they're looking for different things. They're just side benefits to what we think is a really good investment opportunity.
Okay. Well, I think if that's everything from all of us, thank you very much indeed to Dave and Steve for putting on the presentation. We really appreciate it. It's been, from our point of view as the Acumen team, we're delighted, you know, so many people were interested to join us. And obviously we have got other people who want to see this and couldn't actually make this particular meeting. But do please get in touch with us, your advisors, if you've got any queries. More than happy to answer any further questions. And if there are any investments that you'd like to make, then obviously we can facilitate that. And just wish you a very good day, and we'll be speaking to you soon, and we'll, you know, back in touch, you know, with any extra information that we've got for you, and with the link, as John says. So thanks very much indeed, and have a great day.
Thanks, guys.
Yep, cheers.
Thank you. Thanks a lot. Bye.
Bye.
Dave, could you switch me back onto host? Can you do that?
Let me see. I can try.
I think I might have to do something for the recording.
Yeah, let me. How did you do it to begin with?
I think you click on participants and there'll be a list, and my name should come up there. And then if you hover over that, it says more, and then I think you can.
There you go.
Host.
Yeah. Do I want to make John Landy the host?
Budget. Yeah. Brilliant. Okay.
Was that all right for you guys?
Excellent. That was great. Thanks very much. Nice to meet you, Dave, by the way. Obviously, we haven't met before, I think. Yeah, but really good. And thanks very much for coordinating it, Steve. It's that was great. I've got several other clients, that 2 of them that were hoping to join us today and obviously didn't make it for whatever reason. And I've got some other people who, one guy has actually gone into hospital, so he couldn't make it, and there's a few other people that I think might be of interest with it. But I do think, Steve and Dave, we've got clients